For his deep expertise in corporate laws, direct taxation, and accounting standards, CA Manoj Fadnis ji has addressed more than 1,000 technical sessions both within India and internationally, and continues to be a guiding force in the profession. We are honored to have him with us today. With these words, I have the honor of presenting CA Manoj Fadnis ji before this August gathering. Over to Nitin.
Thank you, sir. Before starting the derivation, मैं एक बात कहना चाहूँगा सभी लोगों से कि सेशन जब स्टार्ट हो जाएगा तो डेलिब्रेशन जो है वो सर का कंटिन्यू रहेगा। आप लोगों के जो भी डाउट्स हैं वो आप चैट बॉक्स में छोड़ सकते हैं। आपके जो भी डाउट्स होंगे वो एट द एंड ऑफ द सेशन हमारे ट्रेजरर सीए आकाश गुप्ता जी के द्वारा बाद में जो है वो कंक्लूड किए जाएंगे। वो सर उनको जो है सर को वो ब्रीफ कर देंगे और सर आपका आंसर दे देंगे। तो बीच में कोई भी माइक अपना ना ऑन करे, कोई भी अनम्यूट ना करे, जिससे कि हमारा जो सेशन है वो स्मूथली जो है चलता रहे। इसके लिए सभी को थैंक्स इन एडवांस। एंड नाउ आई वुड लाइक टू इनवाइट आवर इमिनेंट स्पीकर सीए मनोज फडनवीस जी फॉर हिज डेलीब्रेशन।
Thank you, Nitin ji. Very respected President of Kanpur CA Society, CA Akhilesh ji, my very old and dear friend CA Anil Saxena ji, CA Anand Saxena ji, and all esteemed members who have joined this webinar. I am thankful to the President of Kanpur CA Society for giving this opportunity to me. Uh, it is always a pleasure to interact with members in Kanpur, not to least to say the long association and friendship which I have with so many members in Kanpur. My very respected colleague in the regional and central council, Akshay Gupta ji, Rajiv Mehrotra ji, Naveen Bhargav ji, and so many other friends who are there. Also, our former council member, late Shri Nripenji, and so many other stalwarts which Kanpur has produced for our profession. So it is my privilege and honor to be participating in this webinar and sharing certain thoughts and information on the subject of formats which have been issued by the Institute for the non-corporate entities, the practical issues, the difficulties which most of us would have, and the related matters connected therewith. I feel privileged and honored to be part of this webinar. Also, as we speak today, as we meet and discuss today, I would also like to place my deepest homage to our past president of our institute, CATN Manoranji, who passed away just a few days back. He was one of the strongest pillars of our profession, a man with high ethics who has laid the foundation of how the institute can be a partner in nation building. This phrase, partner in nation building, was coined at the time during his presidency way back in 2006. And in very unfortunate circumstances, we lost him just 3 days back. So, remembering him and remembering his high ethical values would, to my mind, be the best way of paying homage to him and to start this discussion on this subject. So, while, as Nitinji mentioned, we can discuss the queries which members have towards the end of the session, and I'll be very happy if somebody could help me with the queries which are being raised in the chat box, while I'll also try and read them and catch up with them as we move along in this session, but we'll take them up at the end. Some of the aspects which are quite common in terms of their applicability, their thought process, and with respect to the issues that all of us are facing. I'll take up those matters as we move ahead. But towards the end, yes, we'll have a more comprehensive discussion on the issues which members may be facing. So I'll just try and share my presentation, which could. Nitinji, I hope my presentation is now visible.
Yes, sir.
Yes, sir.
Okay, thank you. So this is, as Anilji has mentioned, new format which has been issued by the Institute of Chartered Accountants of India, applicable for non-corporate entities. The format is no different from what is there in Schedule 3 to the Companies Act. Previously, it was Schedule 6 to the Companies Act 1956, which was revised in 2011. So this format, which is the vertical format of the balance sheet with classification as current and non-current assets and current and non-current liabilities, we are all used to it for last now more than 10 to 15 years. So while there are other difficulties with respect to non-corporate entities, the otherwise the format, the structuring of balance sheet and the profit and loss account in in this format is generally well known to each one of us. Now, the difficulties which come, and as Anilji rightly pointed out at the beginning, is that while we are aware of it, the non-corporate entities are not aware of it. The majority of the accountants who prepare the books of accounts for the non-corporate entities, the common software programs which are used, do not have this classification and presentation of the financial statements in accordance with this format. And therefore, a lot of time will actually be devoted by the auditors themselves in helping the proprietors, partnership firms to which this applies in complying with this financial statement formats. Now, the difficulties be as they may, if you look at it from the institute's point of view, when an audit is being done and when an audit report is being issued, an audit opinion is being issued, and the auditor says that this profit and loss, the statement of profit and loss or the balance sheet shows a true and fair view. Now, what is true and fair view is not defined in any law. True and fair view is financial statements can be said to be in compliance with this concept of true and fair if the financial statements are drawn up and presented in accordance with the accounting standards. So, therefore, when we have the obligation and not a right, an obligation to certify the financial statements as true and fair, it becomes obligatory for the institute to say that the financial statement should be drawn up in accordance with certain format. And the format, therefore, is the present format which we have. Now, very often this question is asked is what if the format is not followed and the auditor gets the financial statements in the old format? So these are some of the questions which we will discuss as we move forward in this presentation, and subject to whatever practical queries which members may have, we can deliberate upon them. So I propose to, for next 45 minutes to 1 hour, take you through some of these issues and some of the frequently asked questions as clarified by the Accounting Standards Board and the Auditing and Assurance Standards Board of the Institute. And towards the end, there may be some queries which could be there, which we'll try and discuss and deliberate together. Now, the objective of this format is to bring in standardization, harmonize the different practices, and see that the financial statements are in compliance with certain basic norms which are applicable to the accounting world. And therefore, the obligation is on the auditors when we are certifying the true and fair view of the financial statements. There is no obligation on the partnership firm. There is no obligation on the Karta of the HUF who is preparing the financial statements. But when I, as an auditor, and when you and I, as an auditor, certify those financial statements, we have this obligation to certify them as true and fair if they are in compliance with these formats. So this is an indirect method of persuading the non-corporate entities to comply with these formats. This practice is not new. long ago, as some of the senior friends and friends like Anil Saxena ji and Anand Saxena ji would recall, before the accounting standards became mandatory under the Companies Act, even the compliance of the accounting standards by the companies was being questioned. There was no legal obligation for the companies to comply with the accounting standards till such time as somewhere in 1998-99 the Companies Amendment Act was passed, and the Companies Act 1956 had the provisions of Section 210A being brought in, which mandated the compliance with the accounting standards. The accounting standards under the Companies Act were notified in 2006, and in 2021 they have been again notified under the Companies Act 2013. We also have the Indian accounting standards which were made applicable, which were notified in 2015 and which became applicable over a period of time. As I mentioned earlier, the Companies Act 1956 had Schedule 6 to the Act, and that Schedule 6 gave a format of the balance sheet. That format was a horizontal balance format, and there was also a vertical format. So there was a choice. It was only in 2011 that this horizontal format was done away with, and the new format, which was in the form of the present balance sheet vertical format with current assets and non-current assets concepts being brought in, was introduced in the Companies Act 1956 in the year 2011. And of course, when 2013 Act was passed, this Schedule 6 became Schedule 3, and that is how we are dealing with the current formats for the companies. Now, one aspect which we need to bear in mind is while this format brings in the concept of current assets, non-current assets, current liabilities, non-current liabilities, our accounting standard 1 has not been amended and does not have this conceptual aspects relating to current and non-current assets. These aspects are as of today contained in Ind AS 1, which is similar to AS1, but which contains these details, the technical literature with respect to what is a current asset, what is a non-current asset, what is a current liability, what is a non-current liability. There is a lot of education material available under Ind AS with respect to current and non-current classification. And all that literature will be helpful to members while deciding the current and non-current classification as required under these formats for the non-corporate entities. So, while we are dealing with only accounting standards, AS and AS 1 to 29, but the guidance which is also available under Ind AS is relevant and applicable so far as this distinction of current and non-current is concerned. Now, friends, this has been made recommendatory for last few years, and a year ago, or more than a year ago, the council had announced that from the year 2024-25, that is financial periods starting from 1st of April 2024, any financial statements which are drawn up, they need to be in compliance with this accounting style, with this format. So 24-25 and 23-24, which are the comparatives, for 2 years will have to be put into place in this format. Now, there would be difficulties, I appreciate, because this requires restatement of even the previous year's classifications into this format. But that is what is expected to be done if we are to give a clean report on these financial statements. So when we talk about non-corporate entities, the ASB has clarified that non-corporate entities would be any kind of business entity which is not a corporate entity. Today, the corporate entities are companies, any limited liability partnership firms, which are also body corporates, or any other entity which is formed under any statute. The statute could be a central act or a state act, but any entity formed under a statute would be a body corporate. And other than that would be the non-corporate entities. So we have business entities in the form of sole proprietors, Hindu undivided families, partnership firms, association of persons, body of individuals. Then we have trusts, which could be private trusts or public trusts, autonomous bodies, and any other such kinds of business organizations. Now, supposing there is an individual, say a doctor or a lawyer, or even one of us as a chartered accountant, and the individual is carrying on his business or profession in his individual name, not even as a sole proprietor. So, in that individual's case, the financial statements which are drawn up will have to be drawn up in accordance with this new format. So, when we say non corporate entity, it means any entity which is other than a corporate entity. And to them, these financial statements, these formats would apply. Now, there could be cases, friends, where there are formats which are prescribed for certain types of entities. So, to those entities, those formats which are prescribed under the law would apply. So, we have the cases of some of the uh, trusts which are governed by certain state trust acts. And under those trust acts, there are formats which are prescribed for the balance sheet or income and expenditure account. So, when anything is prescribed under the law, that will have a precedence over what is being mentioned or what is being prescribed by the institute. So, for those trusts which are in compliance with the, say, the trust laws, and those trust laws require them to follow a format, they will continue to follow that respective format as notified under the law. But those trusts, societies, partnership firms, HUF, for which there is no law which is prescribing a format for the financial statements, they will have to come and prepare their financial statements as per the format now being now prescribed by the institute. So we have, even for educational institutions, we have a technical guide which has been issued by the institute, which is accounting for not-for-profit organizations. So, educational institutions, charitable trusts, which are governed by that guidance note, by that technical guide issued by the institute, they are required to follow the format given under that technical guide. They did not follow this present format of format which is prescribed for the non-corporate entities. So, what I mean to say is, where any particular format is prescribed under the law, or has already been made applicable by a decision of the institute, then those organizations will continue to follow that respective formats. And for all others, the format presently prescribed by the institute would be the format which would be applicable. Now, this format, like the format which is prescribed under Schedule 3 to the Companies Act, has a set of general instructions which are there, basis which the financial statements have to be drawn out. Now, under the Companies Act, as we know, it is mandatory to round off the numbers to the nearest 100 lakhs or millions, billions, as the case may be. For non-corporate entities, it is not mandatory. The general instructions say that they may be rounded off, because many of the non-corporate entities may have a turnover of, say, 1 to 10 crores also, and which are being audited as required under the law. And their rounding off may not be so relevant and useful. So this is an option given. It is for the entities to decide and their auditors to decide whether they wish to round off the numbers or they want to give the full numbers. While rounding off is helpful in terms of understanding, instead of saying 16 lakhs 32,600, maybe 16.32 lakhs is a better way to understand the numbers. But the difficulty with respect to rounding off, as all of us are practically aware, is that for filing of the income tax returns, there is no scope for rounding off. It has to be in full numbers. And most of the non-corporate entities do not produce financial statements which they circulate to others except the tax authorities and banks and wherever otherwise necessarily required. So for them, it would be desirable that they need not round off and give the numbers as in full numbers so that separate working is not required to be done in context of income tax returns filings. But if some firm or some entity so desires, then it should be rounded off. And what is followed 1 year should be the basis for the subsequent years. Now, this being the first year, it will be useful to decide what is to be done. And accordingly, the rounding off whether to be done or not to be done can then be consistently followed from the few subsequent years. I don't intend to say that if you round off today or you don't round it off today, you cannot change your position in the subsequent years. But by and large, what is expected is consistency, uniformity, and therefore comparability. So, whatever is decided in the first year should, to the extent possible, be also followed in the future years and not changed from year to year. Now, in a companies, we find that we have the financial statements and we also have the director's report. In case of listed companies, besides the director's report, there are many other reports which are included, like there is a management discussion and analysis, there are several governance reports, and so on and so forth. So, in that context, it is mentioned that whatever is once a unit of measurement used, if you're rounding it off, then the same basis should be used in all the other documents which are contained in that annual report. The same principle is also reiterated here, although it has limited applicability because there is no separate partner's report or a proprietor's report or a report of the Karta to the other members of the HUF. It is only the set of financial statements. But within the set of financial statements, if it is being rounded off, then the same unit of measurement should be used in all the notes and schedules in the financial statements. Now, this is a general statement that the disclosure requirements which are contained in the disclosures required as per the accounting standards or disclosures as required in context of these formats is to be based on the principle of materiality. Now, materiality will depend on case to case and based on the facts and circumstances of each unit. Normally, we say in context of listed companies that 2% of net worth or 5% of the profits are what are considered as material items. And basis that, then the materiality would be decided for the purposes of different at the total materiality, performance materiality, transaction-wise materiality, etc. to be decided. It is very important, friends, to keep in mind that while we have this responsibility to carry out the audits, and we are the only ones authorized to carry out even the tax audits. As you know, when the direct tax bill 2025 was before the and it is still before the parliament, a lot of representations were made by other professional bodies that they should also be considered as eligible to carry out the tax audits. One of the very important aspects brought out by the institute was that while other professionals know the taxes and we respect their knowledge for tax matters, what is envisaged here is audit. And therefore, audit being so important and unique by itself, the right to carry out the audit is restricted with the chartered accountants only. Friends, I'm very happy to note that pursuant to the representations made by the Council of our Institute, the Honorable Select Committee, in its report, which has been issued just a few weeks back, has retained this right only with the chartered accountants. So there is a lot of importance which is assigned to our role as a chartered accountant, as an auditor, as a tax auditor, in spite of the fact that majority of the tax audits are with respect to non-corporate entities. And therefore, it also becomes important that we as auditors ensure compliance with all the applicable auditing standards. Now, the auditing standards require us to carry out the risk assessment, carry out risk planning, decide the materiality levels, and these are all applicable in cases of all the audits. So while we retain the right to be the only profession recognized to carry out the audits, even under Section 44AB of the Income Tax Act, these audits need to be in compliance with the applicable standards on auditing. And therefore, the concept of materiality has to be understood in relation to what is there in the standards on auditing. Now, the standards on auditing today require a lot of documentation to be done. If I may just mention that for, say, a partnership firm with a turnover of, say, 10 crores of rupees, I still need to document what could be the risk areas which are to be considered and ensure that the risk assessed, it could be with compliance to deduction of tax at source, it could be in respect of loans borrowed, it could be in context of payments in cash not exceeding 10,000 rupees. These could be the areas of risks. And then I need to ensure that I have prepared an audit program tailored to these assessed risks and ensure that my audit is conducted in accordance with the risk which I have assessed. I need to be documenting all these steps and processes. So the materiality which so decided would be so important to decide what are the disclosures required and ensure that all accounting standards are applied in respect of the material items. Now, as Anilji referred to this aspect earlier, that prior to that in 2021, the ASB had and the council had decided that there would be of four levels for compliance with the accounting standards: level 1, 2, 3, 4. So level 1 was more than 250 crores of turnover. Level 2 was 50 crores to 250 crores. Level 3 was 10 crores to 50 crores. And level 4 was 1 crore to 10 crores. So 1, 10, 50, and 250 were the thresholds for the turnovers. Now, last year, starting for the year 24-25, the council has decided that, as in case of small and medium companies under the Companies Act, there are only two levels which are there. So why have four levels for the non-corporate entities? And accordingly, now we have only two levels also for the non-corporate entities. Entities which have turnover more than 250 crores or borrowings more than 50 crores, they are the large entities. And entities which have turnover less than 250 crores or borrowings less than 50 crores would be covered within the definition of micro, small, and medium enterprise entities. So, if you are auditing a non-corporate entity which is having a turnover less than 250 crores, now this is very important to understand that majority of the audits would be with respect to entities which have turnover less than 250 crores or borrowings less than 50 crores. So for them, they would be classified as small and medium, micro, small and medium enterprises for the purposes of this definition under the accounting standards. The accounting standards which are applicable to them, as such, those standards which are on measurement principles would continue to apply. So if you look at the accounting standards, there are standards. Any accounting standard deals with the principle of recognition, measurement, presentation, and disclosure. There are these four limbs of an accounting standard. The recognition principle is like for the purposes of inventory. What do I recognize as an inventory? Or what do I recognize as a fixed asset? Today we call it as a property, plant and equipment, and traditionally we used to call it as a fixed asset. So the recognition principle of inventory or the recognition principle of a fixed asset is same for a partnership firm or a HUF or an individual as what is applicable to say the largest listed company on the stock exchange, be it Tata Steels or Reliance Industries or any other company. The recognition principles are the same. And then the measurement principles. So if I recognize something as an inventory, how do I measure it? So the measurement principle, as we know, is cost or net realizable value, whichever is lower. Now, this principle is the same irrespective of the size of the entity. So, friends, those accounting standards which are in context of recognition measurements principles are applicable to all entities. So whether I'm auditing an entity with 1 crore turnover or I'm auditing an entity with 1000 crores turnover, the definition of inventory will remain the same. The definition of fixed assets will remain the same. How I measure a fixed asset would remain the same, and how I measure the inventory would remain the same, be it an entity or be a small proprietary concern having a turnover of 1 crore rupees or a large listed company like, say, Reliance Industries Limited having, say, 50,000 crores of turnover. Recognition measurement principles remain the same. So even a MSME unit has to comply with the basic accounting standards which are applicable. Disclosure requirements are lowered and are limited in cases of smaller non-corporate entities. So as Anilji also gave an example of AS80, related party transactions. Now, why it is applicable and the reason why it is applicable is because there is a utility. In context of tax audit, we have this section 48(2)(b), which requires that the purchases made by a assessee the wordings are different. It is not called as related entity, but from the specified persons, whether those purchases or expenses incurred are reasonable. Now, this reasonability and this specified person in the accounting terminology corresponds with the provisions given in AS 18. So therefore, AS 18 is one standard which would apply. Although AS 18 in this context does not apply if the turnover is less than 50 crores. That also exemption is provided. But if, say, what is a fixed asset or what is an inventory, as I mentioned earlier, would apply to all. But say standards like amalgamations, AS 14, or standards like consolidation, AS 21, they would not be applicable in cases of entities like partnership firms because you don't have to prepare a consolidated financial statements of for a partnership firm or for an individual. But in case of a partnership firm, in which, say, a listed company or a larger company is a partner, then for the purposes of that listed company, which is on Ind AS, it has to consider, depending on the facts, but it would be considering this partnership firm as a subsidiary. And therefore, the financial statements of that subsidiary, which is a partnership firm, will get consolidated in that listed company. And therefore the financial statements of listed company of that the financial statements of that partnership firm for the purposes of consolidation will have to be prepared in accordance with Ind AS. But the standalone financial statements of that partnership firm can be prepared on the basis of accounting standards, and if the turnover is less than 250 crores, that partnership firm would be considered as a MSME unit, and it would be regarded as an entity to which these norms would apply. Because only for the accounting purposes it is considered as a subsidiary. Otherwise, under the law, this is not a subsidiary. So these are the basic principles which are to be kept in mind. The threshold limits of that level 1, 2, 3, 4 have been done away with. And now what we have only two levels. Level 1 is 250 crores or 50 crores borrowings, and others, all others would be regarded in level 2, and level 2 units would have lesser amount of disclosures. So, coming back to this issue on related party transactions, AS 18, if the turnover is not exceeding 50 crores or the borrowings is not exceeding 10 crores, then AS 18 would also not apply. Similarly, AS 28 on impairment. Impairment standard generally does not apply in cases of cases of smaller entities. Why it does not apply? And let us understand where impairment standard would really have an application. If I am running a hydroelectricity project of say 5,000 crores and which has a life of 50 years, then over a period of time, there could be impairment in terms of some of the assets. And that is why AS 28 becomes applicable to such large projects. But if I am running a smaller factory and I'm depreciating my assets over its useful life, which may be plant and machinery, maybe 10 years or 15 years or 20 years, normally in those cases, there will not be any impairment to be recognized unless those machines have become obsolete and have to be discarded. So AS 28 has limited applications in context of smaller entities. And therefore, these exemptions have been provided that those entities which have less than turnover of 50 crores did not apply the provisions of AS 28 and the disclosure requirements which are contained therein. But friends, let us again be reminded of the fact that you and I are the only persons auditing that entity, non-corporate entity. You and I are the only persons who are eligible to carry out the audit of those non-corporate entities. And those audited financial statements become general purpose financial statements. General purpose financial statements in the sense the financial statements are relied upon by banks to give the credit assessment to those entities. And therefore, if there is an impairment provision, one must look into that impairment provision even if the standard, even if these applicability norms are not applicable. If you believe that there is an impairment and it should be impaired, then let us not take shelter that technically it is not applicable and therefore I will not make an impairment provision. So the concept of professional judgment is always underlying the auditing principles. Professional skepticism, as we say, and professional judgment needs to be applied while applying these standards in the given context. Then there are certain disclosures under AS 10 and AS 11 where it is encouraged to give those disclosures. And this may not be applicable in cases of smaller entities. So those exemptions are there. Otherwise, AS 10 applies. AS 11 applies if you have a foreign currency transactions, if your auditee is in the business of exports, or is importing material, then to the extent applicable, AS 11 transactions, AS 11 principles have to be applied. It is only those disclosures, specific disclosures, which are in the nature of encouraged to disclose. The exemption is given in those cases. In context of AS 15, it is as such not really applicable in for smaller entities, but it is always better to advise the auditee that it is in the interest of the assessee to or the auditee to take, let us say, insurance policy for meeting the gratuity liabilities. Now, what is the reason why we have AS 15 for post-employment benefits? The Gratuity Act says if a person has worked in a business organization for more than 5 years, then depending on the number of years that person has worked, on the basis of his last drawn salary, 15 days equivalent salary for the number of years he has worked has to be paid to that person at the time of termination of his employment in the form of gratuity. Now consider you are auditing an entity which is largely employing a large number of people, which may be employed for, and it is maybe it is a case of a college or an educational institution. I've seen educational institutions where there are hundreds of people employed, many directly and many through contractual routes, for cleaning, for housekeeping, for other purposes besides the academic teaching staff. Now, if the enterprise has a gratuity liability, and if that gratuity liability is not being provided for in the financial statements, can you say that the financial statements are showing a true and fair view? This is a larger question which the auditor should ask himself or herself, to see that when we are signing the financial statements and say that the financial statements give a true and fair view, will it give a true and fair view if there is a gratuity liability on that business entity, that educational institution, and it is not provided for in the financial statements? And obviously, the answer is unless that liability is provided for, that liability cannot be, the financial statements will not reflect true and fair view. In most of the cases, friends, it would be advisable for the entities to take an insurance policy. They may take it from Life Insurance Corporation or any other insurance company. It is their sweet choice. But if those policies are taken, then whatever disclosure requirements are necessitated by the standard are generally provided by that insurance company to the enterprise, and all compliances can be made. The premium can be properly accounted for, the present value of the obligations can be accounted for, and the financial statements will not only show a true and fair view, the financial statements will have a robust financial position, because that liability is provided for in the books of accounts, and it gives that inherent strength to that enterprise to meet that liability as and when it occurs. So one is that AS 15 is good because it should be complied with, because it makes it is necessary, it is mandatory in some cases, exempted in cases of MSMEs. But more important is it is a comfort to that business owners of that entity, that tomorrow when they have a liability, they would have sufficient funds available to discharge their liabilities. And the only method which is recognized in AS 15 is project credit unit method. That is, if a person is employed for say 30 years, then whatever is the amount to be paid at the end of the 30th year is calculated by way of actuarial methods, and that cost, the present value of that cost is ascertained, and that present value of that estimated cost after 30 years is then spread over this period of 30 years when that person has rendered services to that organization. So AS 15 is not applicable to smaller MSMEs, but I would request members to provide value addition to your clients by bringing to their notice how AS 15 is important and useful to them in the long run, and how easily it can be complied with if a proper insurance policy is taken from any of the insurance companies which deal with these with such policies. Then there are exemptions under AS 19 for leases. Lease standard recognizes finance lease and operating lease. Under Ind AS, the concept of operating lease has now been done away with for the from the lessee's point of view, while from the lessor's point of view, we still have the operating lease conceptually. But otherwise, for the lessee under Ind AS, it is only the finance lease which is there. But under accounting standards, for the lessees, we still have the operating lease and the finance lease. But some of the disclosure requirements need not be complied with by the MSMEs. One very important question which Anilji referred to me a couple of days back, some of the queries which he had received from our esteemed members is, in case of a proprietorship business, should tax provisions be made? Now, normally, in cases of non-corporate entities, the tax provision is not made. But when we are looking at the financial statements from a very technical and strict point of view, if the tax is not provided for, then the profit which is available for distribution to the owners, be it a proprietor or partner, is not the right amount which is coming in the financial statements. Accounting Standard 22 deals with this concept of income taxes, and it requires that the current year's tax should be provided for in the financial statements. Now, let us take a case. I am a proprietor of a business. I have, my business generates, let us say, 50 lakhs of profit for the year. I have other income in the form of rental income or capital gains and income from other sources. My total tax liability and my total income is, let us say, 80 lakhs of rupees. On 80 lakhs of income, assuming for the sake of discussion, my tax liability is 20 lakhs. My business income is 50 lakhs. I'm a proprietor. Now, if you come and audit my financial statements, what is the tax provision which should be made in these financial statements? Should I provide for entire 20 lakhs or should I provide on a pro rata basis? So my total income is 80 lakhs. My tax liability is 20 lakhs. So that is 25% is my tax rate, effective tax rate. My business income, which is prepared, my business profit and loss account, which is prepared, shows a income of 50 lakhs. And therefore, on a pro rata basis, in my business income, I should make a provision for 12 lakh 50,000 in my audited profit and loss account with respect to that business. Because that is the effective rate on which I, as a proprietor, am required to pay my taxes. I will not make a provision for 20 lakhs for the reason that the remaining 30 lakhs as income has not come into my this audited financial statements. And only 30 lakhs, only 50 lakhs has come in, and therefore attributable to this 50 lakhs is 12 lakh 50,000, the effective tax rate, so to say. 20 lakhs on 80 lakhs is 25%, and therefore on 50 lakhs I'll make a provision of 12 lakh 50,000 in my financial statements. Most of us do not make tax provisions in case of non-corporate entities. And technically, strictly speaking, that is not correct. Therefore, I would urge my friends to ensure that proper tax provision is made in the financial statements. Again, let us be reminded of the fact that the Honorable Select Committee of Finance Minister of the Parliament has held that only chartered accountants are competent to carry out the audits. Given that kind of responsibilities, it is our duty to ensure that we follow the correct principles and see that the financial statements give true and fair view. Second aspect with respect to AS 22 that I would like to highlight is, in case of many of the companies also, it is observed that the company has paid say advance tax of 50 lakhs, TDS of 20 lakhs is there, is appearing as current assets. And tax provision appears in the balance sheet as a liability, as a provision. AS 22 requires that if there are advance tax paid and there is a tax liability for the same year, then you net it off and show the net current tax, the net amount, be it a current asset or a current liability in the form of provisions. So if I am paid by way of advance tax and TDS 50 lakhs and my provisions for taxation for a year is say 60 lakhs, then this 50 will be set off against the 60 of provision, and net amount of 10 lakhs will have to be shown as provisions and not 60 lakhs on liability side and 50 lakhs on the asset side. But if I have a liability of 60 lakhs this year and I am having advance tax appearing for the previous year, then that previous year's advance tax cannot be set off against this year's liability. The income tax department has a right to set off all my advance tax, all my TDS, all my refunds against whatever liabilities I owe to the department. Any demand which is due and payable by me, the income tax portal will deduct that that refunds and adjust it to the demands. But I, as an SSE, do not have a right to set off my this year's liability against last year's refund. So that cannot be adjusted. What can be adjusted is a tax provision for the current year and the matching advance tax and TDS of this year, which in any case in my computation of income, I will compare net off, and the net amount which is payable or receivable will appear as payable or refund to the SSE. So to that extent, the netting should be done, and that is also a requirement under AS 22. But let us not mix up this with the earlier years' refunds or demands, because they will not be allowed to be netted off. They have to be shown on a gross basis, otherwise, they have to be shown on a net basis. Now, coming to this concept of deferred tax, most of the non-corporate entities for depreciation follow the method of depreciation prescribed under the Income Tax Act and follow the depreciation rates prescribed under the Income Tax Act. Now, if that be so, there are very few occasions where there could be a timing difference involved, which would necessitate creation of a deferred tax liability or a deferred tax asset. On most of the occasions, the deferred tax is required to be recognized arising from depreciation. Depreciation is the biggest item. And then what could be also a case is Section 43B. I have incurred a liability, but I have not paid it, and therefore it is not allowed to me as a deduction. And because of that, that liability, that amount paid as tax would appear as a deferred tax asset in the year in which it is being created. So look at depreciation and look at mostly items like 43B, which could result in deferred tax being recognized for non-corporate entities. If there are no 43B items, and if there is no difference in the depreciation which is charged in the books and depreciation which is being claimed under the Income Tax Act, then by and large, there will be very few cases, if any, where you will have to create deferred tax assets or liabilities. So that is only a practical way of ensuring compliance with the standards. But as auditors, I would urge you to see that is providing depreciation on written down value basis as per the rates prescribed under the Income Tax Act, is it leading to a very different useful life as against what is the correct useful life of that asset? Now, take for instance a trader having a 10 crores of turnover, or even say 100 crores of turnover, may not have many assets, and therefore this concept of deferred useful life may not be very relevant in that case. But if I'm auditing a partnership firm which is engaged in a manufacturing business and it also has 100 crores turnover, but it may have plant and machinery, building and other assets, say to the extent of 20-30 crores in its balance sheet. And in that case, if I am merely applying the depreciation rates given under the Income Tax Act, then it may not be giving a true and fair picture, because the useful life is the concept which has to be borne in mind for charging depreciation in the books of accounts. The necessity to provide depreciation in the books of accounts is completely different from the concept of depreciation as envisaged under Section 32 of the Income Tax Act. Income Tax Act is an act to tax the income. And if an income is earned from a source, then whatever expenditure is attributable to that source will be allowed as a deduction. That is the philosophy. So if I have acquired assets, but I have not put them to use, I have not used them for the purposes of this business, then the depreciation on those assets cannot be claimed as a deduction for determining the income which is taxable from that source. That is how the Section 32 of the Income Tax Act is worded. But when we come to general purpose financial statements, I have taken loan from a bank. I have acquired plant and machinery, but I have not put them to the use. Does not mean that that asset is not being, there is no depreciation in the value of the asset. And if I have to draw up a profit and loss account to reflect the business of that entity, I must charge depreciation if the plant and machinery is ready for its intended use. So there is a difference between AS 10 and ICDS 5, which is on fixed assets as compared to property, plant, and equipment. For the purposes of audit, we are looking at compliance with the accounting standards. And therefore, we should keep in mind this concept of useful life. As I said earlier, if it is a trading company, trading entity not having significant assets, then it really does not make a material difference if I use the depreciation rates given in the Income Tax Act. But the same analogy cannot be used in case of a partnership firm engaged in a manufacturing business and borrowing money from banks to set up that factory. And there also I say that no, I would apply the depreciation as per the income tax rates, because in that case the financial statements will not show true and fair view. So these are essential things to be borne in mind. And in context of deferred tax, what is the difference between the uh, depreciation charged in the books and the depreciation which is allowable under the Income Tax Act becomes the major area for calculation of deferred tax liabilities. In case it is not material, then you may not have many instances of creating deferred tax liabilities. But if required, then we should ensure compliance with even AS 22. Then these are certain disclosures for intangible assets which should be borne in mind. Intangible assets, friends, is one area where we still do not have an ICDS in the income tax. If you look at Section 145 of the Income Tax Act, it says that the method of accounting would be determined, which is either cash or accrual, and which is consistently and uniformly followed from year to year. So it is guided by the principles of what is the provisions of the Act, then the provisions of the rules, which is in the ICDS. And if there is a subject matter on which there is no nothing contained in the Act or nothing contained in the ICDS, then it is your accounting policies. And the accounting policy then should be in compliance with the relevant accounting standards. Intangible assets is one area where there is, as of today, there is no ICDS. The real estate contracts is another area where there is no ICDS. And there, the relevant provisions of accounting standards would be important to be borne in mind for deciding the accounting policies of those entities. Now, again, let us fall back on the concept of materiality. Materiality, if the intangible assets are not material, if I have purchased only, say, ERP, if my business entity has an ERP, which is an intangible asset, and if the useful life is assessed at 5 years, I may write it off over a period of 5 years. And if there is any other intangible item, then depending on the contractual rights for that intangible assets, that needs to be written off. Otherwise, AS 26 gives a rebuttable presumption that you take 10 years life and write off the intangible assets. But if the intangible assets are very small amount and if I use the depreciation rates given for the intangible assets in the Income Tax Act, it will not make a material difference in my profit and loss statement. So that materiality levels have to be always kept in mind, and materiality levels need to be assessed. As I said earlier, is it 5% of your profit for the year, or it is based on turnover, or it is based on the size of the balance sheets? So go to the standard on auditing for materiality, decide the materiality levels, and then test if these items are material or not material before you decide the application of these standards in the context of the financial statements which you're auditing. Now, provisions, contingent liabilities, and contingent assets, there are certain disclosures contained in para 66 and 67 which are exempted to MSMEs, but otherwise provisions are required to be made. So the standard is applicable. Certain disclosures are exempted in cases of MSMEs. Some of these standards would not be relevant to MSMEs like AS 21, 23, 27, which are on consolidation and which would have no application. Then cash flow statement is again a standard which is not applicable for the level 2 entities. Level 1 entities it would apply. Even for SMCs, there are different levels of exemptions, which not in context of today's discussion, but in context of audit of smaller companies could be kept in mind. Now, I will just turn to some of the important requirements which are given in this uh, guidance note. As I said earlier, the format is same as what is there in Schedule 3. So I need not really take much of your time with respect to the formats. Rounding off, I have already discussed. Current assets and current liabilities is important to be discussed. AS1 does not deal with this topic. To reiterate, one needs to fall back on Ind AS 1 and the education material under Ind AS 1 to decide the current and non-current concepts. But broadly, it is what is the operating cycle. The operating cycle, any assets which is being realized or any liability which is being discharged within that operating cycle would be classified as a current asset or a current liability. Trading criteria, that is, any assets held for the purposes as inventories, would be our items for trading and they would classify as current assets. Then realization criteria is where that you expect the assets to be realized or liabilities to be discharged over a period of next 12 months, would be considered as current assets. So fixed deposits, if they are, what is required to be seen is what is the original maturity of the fixed assets, the fixed deposits. So if I have a fixed deposit which is for more than 12 months, it is considered as a non-current asset. If I have a fixed deposit for less than 12 months but more than 3 months, it is considered as a current asset. And if I have a fixed deposit for less than 90 days, less than 3 months, then it is considered as cash and cash equivalents. So, from the point of view of original maturity, if it is a fixed deposit of more than 12 months, suppose I had made a deposit on 1st of January 2024, maturing on 30th of April 2025. And on 31st of March, that deposit is in my books. It is to be encashed within next 1 month. But this will not take the characteristic of a cash and cash equivalent because the original maturity was not of 3 months. So it needs to be tested from the point of view of the original maturity. I may classify it as a current asset, but it will not get classified as a cash and cash equivalent. That is the point which needs to be kept in mind. So on these, there are so many such practical issues which may come up. Say, for example, I have a receivable. I have not received that data is outstanding in my books for last 3 years. But if I estimate to realize it within next 12 months, I can classify it as a current asset. If on 31st of March 25, I have a reasonable belief that I can realize it within next 12 months, I can classify it as a current asset. But in such a case, because it is outstanding for more than 3 years, and the management or the proprietor tells me and I classify it as a current asset, I must document the reasons on what basis it is being considered as a current asset. It is outstanding for last 3 years. What is going to change that I'm going to get it in next 12 months? What are the reasons on basis of which the proprietor or the partner is telling me that I'll realize it in next 12 months? And as an auditor, I must apply my mind and evaluate whether those reasons are reasonable or not. I cannot just go by a management representation telling me that I will realize it in next 3 months or next 6 months or next 12 months. I must get something in writing from the proprietor, evaluate those reasons, document those reasons, and if I'm satisfied, I can classify it, I can agree to the classification as a current asset. Otherwise, I need to classify it not only as a non-current asset, but also see that proper provision for bad and doubtful debts is made on those uh, long outstanding receivables. Because if a provision for bad and doubtful debts is not made in the financial statements, then it is not, and I'm showing a receivable for an amount and I don't expect to receive it in the normal course of business, then there is a deterioration in the value of that asset. And if I'm not provided for that asset, for that deterioration in that receivable, my balance sheet will not show a true and fair view. We should not be guided by the fact that this provision for bad and doubtful debts is not an allowable expenditure in the income tax. That is the guidance, that is the guiding principle for most of the businessmen. Okay, sir, what is the use of making this provision? I'll not get a deduction in the Income Tax Act. But my duty as an auditor is different from my duty as a tax consultant. So while I am auditing, and I must always remind myself of the fact that only you and I can do the audit. No other professional can step into my shoes and do the audit. The honorable members of the finance committee have again reiterated their confidence in the profession and given a written recommendation to the honorable speaker that this is the only profession which can carry out the tax audits. And all this discussion we are doing for the purposes of certifying the financial statements which are attached to the tax audit report. So our responsibility to ensure compliance with auditing standards is very high. And believe me, if we fail to discharge our duties, a time may come when others may also walk into our shoes. So, as conscious auditors, we should ensure if it is a receivable expected to be realized within the next 12 months, if there are documented reasons available for that, I need to document those reasons and classify it as a current asset. Otherwise, I should classify it as a non-current asset. So that is quite important for us now that we are giving this financial statements in the form of current assets and non-current assets. Hitherto till last year, we used to show sundry debtors and we were not classifying them as current and non-current. Now, if we classify them as current assets, the bankers will come back to you and ask you how these are current assets. These are outstanding for a long period of time. They are not going to be realized in next 12 months. They can come and challenge our audit reports. So please bear these aspects in mind. Similarly, current liabilities. A current liability is any liability which I am supposed to pay, and I do not have the right to defer that liability beyond a period of 12 months. Then it is a current liability. It is to be classified as a current liability. I have purchased fixed assets. Fixed assets are my non-current assets. Liabilities against those fixed assets are current liabilities. Assets are non-current. but liability is to be paid within next 12 months. And therefore, that sundry creditor becomes a current liability. Now, creditors for fixed assets or PPE, as we say, are not trade payables. Trade payables are which are creditors for the normal goods that I purchase. So we need to bifurcate and understand the difference between trade payables and other creditors. Creditors for fixed assets would be classified as other creditors. Trade receivables would be receivables against the receipt of goods sold during in the course of business. If I have sold my fixed assets, which I wanted to dispose of, and there are receivables standing against those sale of fixed assets, they will not be classified as trade receivables. They will be other receivables. So these finer details which we apply in context of Companies Act and in the balance sheets under the which are finalized in terms of the Companies Act, all those principles are important now. Now that given the fact that we will be applying this current non-current classification for non-current non-corporate entities. So that format is slightly tweaked and made in consonance with the requirements of the uh, non-corporate entities. So instead of saying shareholders funds and share capital and reserves and surplus, it uses the terminology like owners capital or owners partners capital account, current accounts, reserves and surplus, non-current liabilities, long-term borrowings, deferred tax, other long-term liabilities, current liabilities, short-term borrowings, trade payables, other current liabilities, short-term provisions, assets, non-current assets, we have PPE, non-current investments, deferred tax, long-term loans, other current, non-current assets. Another aspect I may just draw your kind attention to is that with respect to those which are dealing in shares and securities, their AS 13 applies. AS 13 is for inventories of shares and securities is similar in nature as AS 2, that for we take cost or NRV, whichever is lower. But we take on a script by script basis. Whereas for ICDS, it requires on a portfolio basis. The cost or NRV which is considered is for all equity shares, it would be considered what is the total cost and what is the total market value of each of those. And if the market value is less than the cost, then the cost will be replaced by the market value. So there it is the aggregation which is done, and at the aggregate level, the differences are to be seen. Whereas under AS 13, what is required is on a script by script basis. So these differences which are important between ICDS and the requirements of income tax need to be borne in mind. And the financial statements are to be prepared in accordance with the applicable accounting standards and not as per the provisions of ICDS. So it's already an hour since I've been discussing this. I would just take up one or two other. So this some important aspects which I would like to take up. MSME disclosures are important, and uh, MSME disclosures are required under the MSME Act. And the MSME Act says that whenever an audit is done, these requirements are required to be disclosed on the financial statements. So MSME Act requires even if a tax audit is done for a non-corporate entity, the disclosures prescribed under the MSME Act have to be complied with. Now, in context of fixed assets or property, plant, and equipment, there is one important aspect which may be borne in mind for the purposes of non-corporate entities, and that information is generally not available, is the requirement under AS10 is to show the gross amount of fixed assets and show accumulated depreciation and then the net block. On the face of the balance sheet, what we have is the net carrying cost. but in the schedules or in the notes, we are required to give the gross block less accumulated depreciation and the net block. Now, most of the non-corporate entities may not have the details of what is the gross block, what is the accumulated depreciation, only the net block is appearing. Now, in that case, at least in the first year, this difficulty would be more pronounced. This is even last year, because the accounting standards were applicable, we should have seen that. But now that there is an enhanced importance being given in terms of the format and the standards, we need to be conscious of the fact that the balance sheet will have to show the gross amount and the accumulated depreciations and net block. Now, assuming for some reasons you don't have those details available with the SSE, and that I believe may be the case with many of the SSEs, I would suggest, to the extent possible, please look at last 7 to 8 years tax audit reports. You are most likely you will get the details of what was the assets purchased, what were the assets sold, basis which you can prepare working backwards the required numbers. So that would be the ideal situation. You work backwards, look into the last few years tax audit reports and get these numbers. And you must tell your client that this is a must. I need these details. Let us work on these details and get those numbers. Assuming it is not possible to do it, then in the first year, take the current year, last year's closing balance as opening balance. Somewhere you'll have to make a beginning. And on that point, on that issue, give a suitable note. If the fixed assets are not of a material size to the balance sheet, as in case of most of the trading concerns, it will not affect the true and fair view. Though it is not in compliance with the accounting standards, but it will not be a major departure from the accounting standards if the size of the fixed assets are very low as compared to the other current assets. But in case of a manufacturing company, it is bound to be material. And if an accounting standard is not being complied with, you must make suitable disclosures. If required, you must give a qualification in your audit report in Form 3CB. Believe me, that qualification will have no adverse impact on that SEC, but you will have the satisfaction and the pleasure of having complied with your duties and ensured proper disclosures in your audit report. In case of manufacturing non-corporate entities, if they are not able to generate this information, I would suggest please give a qualification in the main audit report. In case of smaller entities where the size of the fixed assets is not very important or not very material, not very significant, you may consider giving an emphasis of matter that this is not being complied with and the closing balance of last year is considered as the gross block and that is the starting point for the subsequent years. But this is one important aspect, that a reconciliation of the opening and closing should be provided, not only for this year, but also for the previous year. Then AS 13 requirement with respect to non-current investments, all this needs to be kept in mind. I am skipping some of these slides only in the interest of time. Inventories is important because inventories, I believe the two important accounting standards are on fixed assets and inventories. They apply by and large to every trading concern, and of course the standard on revenue recognition. So these are basic standards which are applicable in all cases, and compliance with these standards must be ensured before we give a true and fair view on the financial statements. So this is on the profit and loss. The format which is here is same as Schedule 3. Revenue from operations. Revenue from operations contain revenue from operations and other operating income and other income. So please mind the difference between other operating income and other income. Sale of fixed assets is other income. Subsidy received is other income. Interest earned is another income. Foreign exchange gains are other income. But sale of scrap is other operating income. Anything which is related to my operations and derived from that becomes revenue from operations. And it could be part of other operating income. So the difference between other operating income and other income is very significant and needs to be kept in mind. So I would be sharing this presentation with the society, and therefore I'm not going by every slide. But before I close, I would just like to take you to a very important aspect with respect to uh, not-for-profit organizations. So we are auditing hospitals, educational institutions, all charitable institutions under Section 11 and 1023C. We have this report in Form 10B and double B, which are in any way quite complex. And I have always been holding a view, and I had certain seminars where I stated the non-charitable tax provisions relating to charitable institutions. One of the most complicated tax return preparation is with respect to charitable institutions. Generally, the charitable institutions will think they are doing charity. The auditor is also doing charity, and they will not be paying you the appropriate fees. But that does not mean our responsibilities go down any bit. So, what has been clarified by the ASB is that for not-for-profit organizations, that is for all those entities where we are issuing Form 10B and double B, the format is not the format which is prescribed for non-corporate entities, but there is a format which has been prescribed in a technical guide issued by the institute a few years ago, and that format is the one which is applicable. So that format essentially talks about restricted funds and unrestricted funds. So while the normal accounting is based on what we discussed about revenue and sales and purchases and trading account as we have been used to, here the concept is a fund-based accounting. And in a fund-based accounting, this concept of restricted funds and unrestricted funds are important. So as you will see in this format, uh, this is the format of the balance sheet. So sources of fund in uh, unrestricted funds, restricted funds, and then you give all those details, which are corpus, which are designated funds, which are funds for the purposes of accumulations. You give them specifically under the specific heads. In context of income and expenditure account, again, the income and expenses are to be categorized as unrestricted funds, restricted funds, and similarly for the previous years, preceding years. So not only for March 25, but also for March 24. So for a charitable institution, educational institution, we are not going by current assets and current liabilities classification. We are going by this concept of restricted funds and unrestricted funds. And this guidance note is separate. So while we are for educational institutions and charitable institutions, please ensure to use this format of income and expenditure. And this would also require you to specifically analyze the items as what are restricted, what are unrestricted, and ensure proper compliance with this technical guide. It is not a guidance note, but it is a technical guide. And there is a very technical difference between the two. But from a practical point of view, whatever is issued by the institute has to be accepted and complied by us as practicing members. So with this, I will, Anilji, pause for the time being. draw your kind attention to the members that there is a FAQ which is issued, and a very simple question answers. That FAQ has put in certain questions. So what is one of the question which Anilji has had referred to me was, what is my responsibility if the audit is not giving it in the format? Because ultimately we say the responsibility is of the auditee. Practically, I know how much responsibility the auditee takes up and how much responsibility we take up. But technically, it is the auditee's financial statements prepared by the auditee and subjected to audit by the auditor. In that case, if the auditee is not preparing it as per the guidance note in the format prescribed by the guidance note, then the auditor has the responsibility of giving a disclosure in the audit report. That disclosure could be a qualification or it could be an emphasis of matter. And whether to give an emphasis of matter or qualification is a matter of professional judgment of the auditor. In most of the cases, to my knowledge, in case of non-corporate entities, an emphasis of matter could be sufficient. That in Form 3CB, you make a proper emphasis of matter as per SA 706 to state that the financial statements have not been prepared in accordance with the guidance note issued by the institute. Our opinion is not modified to that extent. But in some cases, if you believe that it is going to affect the true and fair view, and that is where as an auditor, you need to take a decision and take a professional judgment, then you need to qualify and say that the profit and loss account and statement of profit and loss and balance sheet give a true and fair view subject to these qualifications, that they are not drawn up in accordance with the format issued by the institute. So that is a disclosure would certainly be required, whether it is an emphasis of matter or it is a subject matter of qualification will depend on case to case. So I will halt at this point of time, and I'm thankful once again to our president of the society and to all my friends who are there, Anilji and others, helping me in this session. I'll be too happy to take up any questions which may be there with our members.
Thank you, sir. आकाश,
Yes,
प्लीज
sir.
जो आपके क्वेश्चंस हैं वो सर के सामने एक बार रखेंगे तो सर अपना आंसर सबके सामने रखेंगे.
Okay, thank you.
Akash, please ensure that you do not take up questions which Fadnis is already addressed in his.
Actually, the questions which are mentioned here, few are received via Google form and few are mentioned in the chat box. Most of them will be repetitive, like all are covered in webinar, but still few of them if I'm taking up.
Go ahead.
First, I'm taking those which have been received via Google form. The number one is whether tax provision on income mandatory to show in PL in case of proprietorship firm.
Yes.
If so, whether tax is only to show in respect of business income or total income including other sources.
So I had discussed this earlier.
Yeah.
जो आप बिजनेस का प्रॉफिट एंड लॉस अकाउंट बना रहे हैं, उससे रिलेटेड जो आपको टैक्स लग रहा है उतना प्रोविजन आपको करना चाहिए. अब इन केस ऑफ प्रोपराइटर ऐसा तो नहीं है कि डायरेक्ट 25% और 30% ही टैक्स है. देयर आर डिफरेंट स्लैब्स, देयर आर डिफरेंट डिडक्शंस. तो आप टोटल इनकम निकाल लीजिए, टोटल इनकम पे कितना टैक्स आ रहा है, उस प्रोपोर्शन में बिजनेस इनकम पे टैक्स पकड़िए और उतने का आप प्रोविजन फाइनेंशियल स्टेटमेंट्स पे कर दीजिए.
Next one. What to do when financial statements has been prepared by management not complying with the mandatory guidance note of ICAI?
अभी बता आकाश लास्ट में.
आप FAQ देखिए सर, इसमें आप
हाँ.
एम्फेसिस ऑफ मैटर या क्वालिफिकेशन जैसा उचित समझे वैसा दीजिए.
One more is it mandatory to follow the format or show comparative figures? Guidance notes are supposed to be recommendatory in nature. Can a CA exonerate from his liability by simply giving a note or qualification per se?
देखिए सर, एज अ ऑडिटर आप तो पहले ये समझिए कि you are carrying out this audit because you are a chartered accountant. And only you and I, as chartered accountants, can carry out this audit. We must ensure compliance with everything that the institute says. आप इसमें मत जाइए कि ये मैंडेटरी है कि रिकमेंडेटरी है. Recommendatory does not mean it is optional. Guidance notes are required to be followed by auditors, and if there is a reason that I can document कि भाई इस कारण से मैं ये गाइडेंस नोट फॉलो नहीं कर सकता हूं, and they should be valid reasons, then you can depart from the guidance note. Accounting standards and auditing standards are mandatory, उसमें कोई choice नहीं है. Guidance notes are recommendatory, but people assume recommendatory that they are optional. They are not optional. They are also to be complied with. But in some cases, you can depart from from a guidance note if there are valid reasons. So the philosophy that we should follow is, even if it is a guidance note or it is a technical guide or we say expert advisory committee opinion, जो भी institute ने लिखा है दिया है, we should take it first as our Gita and follow it up. Let us not go into this debate of recommendatory or mandatory. It is for all practical purposes mandatory for us. That is how we should follow.
Next one is, please elaborate on previous year disclosure and PPE disclosure.
सब previous year's figures देना जरूरी है. PPE एक जो problem आता है, which I mentioned is, I may not have the numbers of cross block and accumulated depreciation. Efforts should be made first to determine them from the earlier years audit reports. If you see last 7-8 years audit reports, by and large, you will get sufficient information of purchase and sales. So you can arrive at what would be the gross block and accumulated depreciation thereon. If that effort cannot be done, then you may say take the today's numbers as the starting point and give suitable note in the financial statements and also in your tax audit report.
Few of them are given the chat box. Number one is, whether trust not doing any business are non-corporate entity in regard to preparing financial statement.
देखिए साहब, trusts, it is एक बड़ा important question है कि trust is not doing business. So does it mean it does not have to follow accounting standards? Answer is no. If I am carrying out an audit, I must see that the applicable accounting standards are complied with. And therefore, the trusts, whether carrying on business or not, even if they are carrying out charitable activities. Let us take an example of a trust. उसको donations मिलते हैं. It gets a plant and machinery as a donation. अब इसकी accounting आप क्या करेंगे? You can account it because it is donation, it can be accounted at 1 rupee. If the value is, say, the present value is, say, 1 crore. If I use the fair value accounting, then I should show the grant at 1 crore of rupees. So, to bring in uniformity, it is necessary that this trust should also comply with AS 12 on government grants. And AS 12 says that you account it at nominal price. You account it for 1 rupee. You cannot account it for 1 crore of rupees because you are following historical cost concept. So let us not have this in mind that accounting standards are to be applied only when an entity is doing business. Whenever the financial statements are being prepared and you as an auditor are certifying the true and fair view of the financial statements, unless they are in compliance with the accounting standards, you cannot say that they show true and fair view. अगर मान लीजिए किसी ने 50 लाख ले लिया, किसी ने 1.5 करोड़ ले लिया, will that be correct? Answer is no. To have uniformity between all trusts for general purpose financial statements prepared on historical cost basis, they will be reflected at a price of 1 rupee. So whether the trust is doing business or not, compliance with accounting standards is a must.
Next one is professional responsibility remains binding on CA irrespective of whether the client is legally required to adopt the standard, and could failure to comply result in disciplinary action under CA Act?
Yes, sir. If an auditor is not complying with the guidance note, not giving disclosures in the audit report, merely because saying कि उसने financial statements बनाए उसने नहीं करा, does not absolve the auditor of the responsibility, and institute can surely take disciplinary action against such auditors.
The last one is, what if CA is not required to sign on financials? Suppose in case of non-audited cases, still new format is required.
देखिए, very valid question. अगर किसी का ऑडिट ही नहीं हो रहा है और उसने उसके फाइनेंशियल स्टेटमेंट्स जैसे हर साल बनाता है बना दिए हैं, तो ठीक है, there is no problem, there is no law that he should prepare as per this format. It is only when they are being subjected to audit they should be in compliance with these formats. If some auditee, some businessman comes to us and says ki, please draw up my financial statements, you are a chartered accountant, tell me how it should be prepared, then I must ensure that they are prepared in accordance with the new formats which have been notified by the institute. But if somebody is not getting it audited, वैसे ही बना लिए तो ठीक है, जैसा वो चाहे बना ले. अगर हमसे पूछे तो हम तो ये कहेंगे कि साहब ये फॉर्मेट है इसमें बनाइए. अगर आप नहीं मानते हैं, जैसे करना है आप करिए, योर चॉइस.
That's it. Rest are, I think, repetitive, so I'm skipping those off. Thank you. Over to
Thank you.
Nitin.
थैंक यू आकाश, आपने सारे क्वेश्चंस कवर कर लिए हैं और सर ने बहुत ही अच्छी तरीके से उस क्वेश्चंस का रिप्लाई भी किया हुआ है. चलिए सेशन को एंड की तरफ करते हैं. मैं इनवाइट करना चाहूंगा सीए अनिल सक्सेना सर जी को. प्लीज अपने क्लोजिंग रिमार्क्स दें.
आई थिंक फडनिस जी के बोलने के बाद कुछ भी समराइज करना भी जरूरत नहीं है. बट द फर्स्ट टाइम मैंने जब फडनिस जी को सुना था, इफ आई रिमेम्बर समवेयर अराउंड 1991 के आसपास, यहाँ कानपुर में गीत होटल है, ही टॉक्ड ऑफ AS22, और AS22 में तब क्लैरिटी नहीं थी. बट आई थिंक इवन दैट टाइम इनके क्लैरिटी ऑफ थॉट्स सुन के आई वाज ओवरऑल्ड, एंड आई थिंक द सेम क्लैरिटी ऑफ थॉट आज भी दिख रहा है. इट इज 2 घंटे ऑडिट के सब्जेक्ट पे फडनिस जी बोले, एंड आई डाउट एनीवन वुड हैव गॉट बोर्ड विद द नॉर्मली ड्राई सब्जेक्ट्स जो ऑडिट के माने जाते हैं. इट वाज ट्रूली अ वंडरफुल प्रेजेंटेशन. 2-3 चीजें जो सर ने बताई, आई थिंक विच वी ऑल नीड टू रियली remember is, number one, we need to probably write it down on our board, the whiteboard besides us, that we have the pleasure of being the only profession who have been retained for auditing, and this obviously means that as a profession all of us need to whatever trust has been given to us by the committee, I think we need to ensure that we comply with everything. And सर ने आई थिंक बहुत सारी चीजें बताई, बट 2 चीजें मुझे जो रियली इम्पोर्टेंट लगती हैं, जो स्मॉल एंड मीडियम फर्म्स हम लोग जो सब लोग प्रैक्टिस करते हैं. नंबर 1 इज इंश्योरिंग डॉक्यूमेंटेशन, और स्पेशली स्टैंडर्ड्स ऑन ऑडिटिंग की. And most of all, I think, the place where we need to start the audit risk and then the materiality. In fact, materiality एक ऐसा concept है जो मेरे ख्याल से right through the audit हर आदमी को they should remember, just like their probably mobile phone or maybe, their vehicle car number. But anyway, sir, Fadnis ji, thanks a lot for truly, I have around 2 or 3 pages of things which I've noted for compliance with respect to the non-corporate financial entities. I think बहुत सारी ऐसी चीजें थी जो बहुत practical examples दिए, especially with one with respect to whether we need to qualify or give a EOM when it comes to non-compliance with the format of the financial statements. And most of all, जो सबसे ज़्यादा stand out करती है is AS10. I think AS10 हमेशा से ever since tax audit आया है और AS10 apply करता था, I think most of us would be qualifying this AS10 because generally सब जगह gross block कभी भी नहीं मिलता था. But I think Fadnis has given a very, very practical listing that, okay, wherever it is not material, at least, work back and then try and work in it and then give a emphasis of matter or another matter depending on, how it is in the notes and account. Thank you once again, Fadnis ji, and also the members who were here and made this webinar a great success. Over to you, Nitin.
Thank you, sir. Now it's time I would like to invite CA Akhilesh Tiwari ji, President. Please give a memento in webinar form to CA Manoj Fadnis sir, and memento will be further sent to sir by post.
Thank you, Manoj sir. Basically, when I was elected as a convener of KCS Study Circle, CP Study Circle in 2021, when the entire nation was hit by COVID. And we had requested our Manoj Fadnis sir, Vice President sir, for taking webinar on 7th of September 2021, and he at the time also agreed and spared his time for tax audit. He has given at that time the tax audit session, and now he has given us time for non-corporate entities statement, which is very, very relevant, and you can say that hot topic for today's. Basically, we are the small practitioners, capturing the needs of small firms and what to do, what to not to do. And your entire session has helped us a lot. And thank you, sir. Thank you so much once again. And this is our memento, and which will be dispatched to you through the courier right now, today itself. And thank you so much for the effort, and thank you for our Anil sir, Anil Saxena ji, chairman of our Audit and Assurance Committee, and Anil Saxena ji, co-chairman, and most of all the participants. We have reached the strength of 130 plus at one moment of time. So this was great. In any webinar, it is the attraction of Manoj sir, who has dragged all the population. And thank you, sir. Thank you so much.
I think, Akhilesh, we need to also appreciate that Fadnis ji ki wajah se non-CP program mein you had that number. That's the credit.
Thank you, sir. Thank you.
Thank you. Over to Nitin.
Thank you, sir. I would like to call CA Vineet Rungta for a formal vote of thanks.
Good evening, everyone. It is indeed a privilege for me, on behalf of the Kanpur Chartered Accountant Society, to extend the vote of thanks for today's enlightening webinar on issues in non-corporate financial statements. At the outset, I express my heartfelt gratitude to our keynote speaker, CA Manoj Fadnis ji, past President, ICAI. Sir, your address was not only insightful, but truly thought-provoking. The way you articulated the applicability and the nature of guidance notes, clarified practical aspects of accounting standards, and emphasized the significance of MSME disclosures in audit reports and financial statements, provided immense clarity and guidance to all of us. It was indeed a knowledge-rich session. I also extend sincere thanks to CA Anil Saxena ji, Chairman of Audit and Assurance Committee, for your gracious presence and valuable inputs that added further depth to our today's deliberation. A warm appreciation goes to our ever-committed leadership team, President CA Akhilesh Tiwari ji, Secretary CA Nitin Omar ji, and Treasurer CA Akash Gupta for their continued dedication towards empowering the CA fraternity with such meaningful and timely knowledge sessions. It is happy to note we peaked a presence of more than 130 audience today, which is one achievement, and I definitely thanks our speaker for that.
Thank you.
To our esteemed participants, thank you for joining us in large numbers and making the session engaging. Through your attention and interactions, your involvement truly drives the success and our initiatives. Lastly, I commend the efforts of our entire managing team and the technical support team for flawlessly executing today's webinar. With that, we conclude the enriching session with a renewed commitment to continuous learning and professional excellence. Thank you, sir. Thank you. Over to Nitin.
Thank you very
Thank you,
much.
everyone.
Thank you.
And
Thank you, sir. Thank you, sir.
Thank you. Thank you, Anilji.
thank you, sir.
Thank you.
It was
Now
really very,
we
very
can
nice.
leave the meeting. Thank you, sir.
Thank you.
Thank you.
बाकी सबको तो